Hello. So we are now moving on to chapter 5. In the first two chapters, we talked about the auditing profession, the agencies that govern that profession. We also talked about the different kinds of reports and the generally accepted auditing standards that should be used to prepare those reports. Now we're going to talk about when we get an audit engagement. Okay, the way this class works is the first section talks about the auditing profession, preparing for the audit, okay, and overall gaining an understanding of the internal control of the company that we're auditing. The second section talks about the audit itself, what I call getting your hands dirty by doing the actual audits. And then the third and the final section is about, a little bit of the audit itself and then wrapping up the audit and issuing the reports. So this chapter, chapter 5, is about audit evidence and documentation. Okay, and so as we discussed, the stages of an audit: first, you have to obtain an engagement, then you have to plan for the engagement, assess the risk. As we discussed in chapter 1, these days audits are all about a risk-based approach, risk assessment, doing the actual procedures, the second section of this class, and then reporting on the audits. Okay, now Statement of Auditing Standards 109 states that to obtain an understanding of the client and its environment, including its internal control, to assess the risk of material misstatement is the risk assessment procedure. You can see SAS 109 was written recently, okay, that to obtain an understanding of the client and its environment, including its internal control, to assess the risk is what we call the risk assessment. The risk assessment is needed before we conduct an audit because we need to find out what are the risks involved in this audit. What can go wrong? The accounts payable department, is not preparing the checks in accordance with the procedures, or the accounts receivable department is not collecting properly. The bank statements are not being reconciled. Okay, the treasurer is also in charge of record keeping function and has a conflict of interest. All these things combined create a weak internal control environment, okay, and the risks could be very high. And so that's what we mean by the risks. So what are the risks involved? Okay, and all these risks involved can mean that the audit may not provide the right conclusion. The risk is that you may give an unmodified report, but in reality you should have given a qualified or an adverse report, okay? And that risk is the risk that an audit may not provide the right conclusion. And it is called the audit risk. Okay. So it is possible that the auditors may end up providing an unqualified or an unmodified opinion on the financial statements when there are irregularities and departures from GAAP that have not been detected. Okay. As we learned in chapter 1, management will assert and auditors will attest. What are the auditors attesting? The assertions of the management. And what is the management asserting? In a way, they are making 5 assertions. Okay? And what are those assertions? The transactions that have been recorded have occurred and they do exist. First, existence or occurrence. These transactions do exist. These sales transactions have really happened. Okay? And these assets really exist. Existence of transactions. That the company holds the right to the assets. This cash is owned by the company. And the liabilities are the obligations of the company. We will learn during the course of this class that businesses who want to be in a favorable light will tend to overstate assets and understate liabilities. Why? That's the risk, of course. Think about this. When you debit an asset, you are crediting revenue. Debit cash, credit revenue. Debit receivable, credit revenue. With liability, why understate them? Because when you credit a liability, you are debiting an expense. Okay, so if you don't do that, expense is low. On the other hand, if you do this more, revenue is higher, and both of them lead to higher net income, which is what the investors want to see. Okay, so rights and obligations are important. Do they really own the assets? Okay, have they disclosed all the legal liabilities? Important, all transactions have been recorded. Are all financial statements complete? Okay, all transactions on the financials that need to be recorded have been recorded. And are all financial statements complete? What do we mean by that? Think about a scenario when a company is under a lot of pressure, okay, to meet their income projections or their sales projections. What may they do? They may tend to take the invoices from December and post it, my fault, the vendor bills from December and post it in January. Why? Because in December, where the transaction that needs to happen is debit expense, credit liabilities, they may do it in January, which means lower expenses, higher net income. Completeness, okay? That they did not completely record everything. So in a way, while we say 5, this is looked as 1, completeness and cutoff. Transactions and events have been recorded in the correct accounting period, okay? If they have not, then the financials are not complete. Year end. So the example that I gave you was to ensure that the net income is higher by showing lower expenses. Or you could take invoices from January and book it in December to show a higher revenue. Okay? And we need to do a test of cutoff to make sure that none of that has happened. So while we say 5, in a way this two can be combined into one assertion. That the management is saying we have recorded all financials completely and they have been recorded in the correct accounting period. All transactions of the financials are reported proper amounts. Inventory has been valued correctly. Bad debt allowance has been booked correctly. What do we mean by correctly? Accurately. Okay? So, they have been valued correctly and everything that needs to be presented and disclosed, legal liabilities, lawsuits, has been disclosed. Okay? Accounts are described and classified in accordance with GAAP, and all disclosures are complete, appropriate, and clearly expressed. Why is that? To make sure that investors are not misled into something and all relevant information to make a decision has been disclosed. The risk that there is a material misstatement in any of the above assertions is inherent risk. Okay? And what characteristics indicate the highest amount of inherent risk? What is an inherent risk? That something can go wrong in any of the above assertions. Okay, why they can go wrong? Management dishonesty, accidental fraud, accidental errors, or actual fraud. So, the characteristics listed below indicate the highest amount of inherent risk. What do we mean by that? These are the situations when this risk can increase. Profitability is inconsistent. In a highly competitive industry, when one competitor comes into the market, it can have a significant impact on the profit, okay? Or a tobacco industry. Regulations, the Republicans come into power, relaxation of regulations. Democrats come into power, tightening of regulations with the tobacco industry. Inconsistent profitability. You need to understand the market to make sure that you understand what impact it can have on the financials. Highly sensitive to economic factors. Good economy, more vacations. Tourism industry improves. Has an impact on financials. Going concern. Anytime a business, what is a going concern? The concern that next year this business may not be in existence. It obviously increases the risk over here. Prior audits detected large misstatements. There are a lot of misstatements detected in previous audits that need to be looked at, which tells you that either management is very overly aggressive and is trying to fudge the books, or the staff is not competent to prepare the financials and they are making a lot of mistakes. Either way, this risk is increased. Okay? A lot of times in small businesses, there is one person who has the knowledge of the entire process. If that person quits, then that means it's a big impact on the business. What does that do? What that will do is it will ensure that other people who don't know the total aspect of the business, their work is not being corrected or checked, and then they may make a business and financials may not be accurate. Increases this. Okay? Enron kind of management, overly aggressive. And then inadequate accounting skills of management. What do we mean by that? I believe that in my auditing career, this is the risk that I have found the most. Let me give you an example. In the past, if you have worked all your life as an AP clerk, as an entitlement, the accountant position opens up, you may get promoted as an accountant. You may not understand debits and credits. Look, how many years have you spent right now to come to this level? Okay. And someone who has not gone through the school but has only done accounts payable is just promoted because as an entitlement may create a lot of risk that they may not understand the implications. Okay. I have seen in businesses this happen. I have seen people who are great at collections, meaning that very aggressive and they can collect, are made accounts receivable managers. They may be great at collections, but they may not know record keeping. And so in my personal opinion, while all these things are important, but the most frequent is this one. But that definitely increases the inherent risk as well. Okay, so we need to understand that too. Now, management judgment increases that risk. Those transactions that require management judgment or assumptions have the highest amount of inherent risk. Complex calculations, okay, difficult in the construction management, revenue recognition, okay, any area that requires management judgment, for example, mark-to-market accounting in Enron, okay, will increase the risk. Valuations that vary significantly based on economic factors, difficult accounting issues, significant judgment by management. All this will increase the risk that things are not going fine. Okay? The risk that material misstatement could occur in a relevant assertion and not be prevented or detected on a timely basis by the client's internal control is controlled risk. All right. So let me try to tie this with this. First is the environment of the company is such, all these things, that there could be misstatements. Now, if there is misstatement, the overall control environment is such that these misstatements may not be able to be caught and not prevented or detected. Okay, and a CFO. Nowadays, businesses prefer having a CPA, not just an MBA in finance, but a CPA to be a CFO. Why is that? Because of this particular risk. The risk that the controls are not working properly, due to which things cannot be prevented or detected. Because the tone at the top is very important. Okay? And that person would know that my accounts receivable manager cannot be someone who may be good at collections but does not even have an accounting degree. Okay? That person would know that. And so automatically that risk decreases. A risk-based approach. When these two are high, there's a good chance that you, the auditor, will not be able to detect what you need to detect, and that's the detection risk. And it is dependent upon the effectiveness of audit procedures and applications of those procedures. Now, this one is not in your hands, you, the auditor. This one's not in your hands because this was the situation given to you. This one is not in your hands either because that's the situation that you had to deal with. But this one is definitely in your hands, okay? Because it depends on the quality of audit, the kind of audit that you would conduct. Effectiveness of audit procedures and application of those procedures by auditors. Let's take a look. It's like a gravel. Okay, risk of material misstatement. Misstatements likely to occur in the client's financial statements. If this is poor, and a good internal control can catch it. Okay, misstatements prevented or detected by controls. If that does not happen, then you would be able to catch it. Okay, detection risk. Misstatements that are not caught here can be caught by the quality of audit that you do, detected by your procedures. Okay, and if you cannot catch it, then they are missed. And that increases the audit risk. So the audit risk is a combination of AR equals IR times CR times DR. Audit risk equals inherent risk times control risk times detection risk. Okay? Assume auditors have inherent risk for a particular assertion at 50% and control risk at 40%. You may ask, well, how do they decide this risk? Based on the judgment. Okay? You have been doing audit for so many years. You look at the overall control environment and you come up with this judgment. Okay? They have performed procedures that they believe have a 20% risk of failing to detect a material misstatement. So the audit risk may be computed as follows. 50%, 40%, 20%. Thus the auditors face a 4% audit risk that material misstatements has occurred and evaded both the client's controls and auditor's procedures. Okay, AR equals IR times CR times DR. Now, the stronger your evidence, the less is this risk. And that's why SAS 106 states that auditors must obtain sufficient evidence by performing audit procedures to perform a reasonable basis for an opinion regarding the financial statements under audit. Okay, if I know, before I get here, and I'm going to stop here for a quick minute for you to read this. If I know that I need this to be at 4%, I cannot control this. I cannot control this. But I can control the detection risk. What do I mean by that? In a lousy control environment, in a lousy environment where inherent risk is very high, I, the auditor, had to plan an audit to do much more work. Why? Because I want to make sure nothing goes undetected, because I have to bring this to an acceptable level. Okay? So that's why I have to even put much more stress on getting audit evidence. By performing audit procedures to perform a reasonable basis for an opinion regarding the financial statements under audit. Okay, so I want to stop right here. I want you to go back and read whatever we have done so far, and then we get back onto this again. So I'm going to stop here. Of course, you won't know it because immediately the lecture of the next part will start, but this is how you need to focus on stopping, reviewing in your workbook what we have discussed, and then we can move forward. Okay, moving on to evidence. So as we discussed, to make sure our audit risk is not that high, what we have to do is gather relevant and reliable evidence. Okay, when we say relevant and reliable evidence, what kind of evidence is relevant and reliable? Audit evidence is more reliable when it is obtained from knowledgeable independent sources outside. Instead of internal, external evidence is more reliable. And internally through a system of effective controls. A bank statement is more reliable from a bank is more reliable than simply a ledger that shows the balance. Outside parties. Through a system of effective controls. A ledger in the system that has input all the where all transactions have been input is more reliable than an Excel spreadsheet because it's a effective controls. An accountant preparing a summary of accounts receivable is more reliable than someone who has no accounting background because you presume that that person knows what he or she is doing and may be able to come up with a better quality report, more trustworthy report. Okay, so outside better than internal, and generated through effective controls is better than ineffective controls. Okay, if you write a letter and ask them to send it directly to you instead of sending it to the business, is more reliable. Why is that? Think about it. You chose a sample of 3 bank statements and you told them to send those bank statements to your client. Then the client knows the sample you have picked, and then they may try to modify the ledger instead of you asking the bank to directly send it to you. Okay, and then check it so that only you know what your sample is. Okay, just like documentary evidence in the court has more weight than oral, same is true in auditing. Okay, original documents rather than copies is more persuasive evidence. A good accounting information system, documented from outside parties, you can see with your own eyes. Computations. What do you mean by computations? If the debt has increased, doesn't that mean that the interest expense should also increase? You compute and you find out yourself to be that to be the case, more reliable. And that's what we mean by this one as well. And the last is client representation. You may think, well, does that mean that we never trust our client? Well, it's not about trust. Remember, professional skepticism. Okay? That's what we're talking about. And how can you achieve that? Through substantive procedures. You will detect misstatements at relevant level. Substantive procedures include analytical procedures, test of details, transactions, and disclosures. So let's talk about analytical procedures. I just gave you an example of analytical procedures. If my debt is high, my interest expense is going to be high. If my receivable has significantly increased, then there are 2 possibilities. The collections efforts have deteriorated, which creates a risk that cash may not come in, or the revenue has increased. If the business has grown and they have purchased more assets, depreciation expense is going to be higher. See, analytical procedures, okay? Test of details of account balances. 50 customers outstanding balance adds up to 50,000. Then I need to look at the ledger to see if the ledger balances, the subsidiary ledger balances with what the outstanding balance states, and then transactions and disclosures. Okay, when you start an audit, you do an analytical procedure initially to see if what kind of areas you may need to do more work on, and we will discuss that in more details later on. And then you may do test of details, which is actually picking out a sample and reviewing it, okay? And then actually transactions and disclosures will be the last part. The higher the risk, the greater the need for extended substantive procedures. What do I mean by that? Okay, and this is very important for you to understand. I have been auditing this company for the last 10 years. The head of the accounts receivable department is a person of impeccable integrity, has very good accounting knowledge, okay, is a CPA, has been working here for 7 to 8 years, knows the risks involved. This person, the accounts receivable VP, manager, whoever it is, knows what you're going to be looking at because you have been working with them for 7 to 8 years. You know the way they work. So when that happens, you know that you are expecting something that you will get. Now, on the other hand, let's look at the opposite. The opposite situation is when someone who this is your first year of auditing this particular company, you have found out that there is no one really in charge of accounts receivable. There are a few clerks doing stuff who don't have the accounting background, and the CFO happens to be an engineer by profession and has just gotten this position because of working over there for many years. You may laugh at this, but it happens all the time. Okay. Now, in that situation, the risk has significantly increased. As a result, you may need to do more work. Why? Because AR equals IR times CR times DR. The chances that something may not be detected significantly increases. Okay, so that's why this is very true. You may see quite a few questions based on this concept. It's important for you to understand this. All right, moving on to analytical procedures. Unusual events, transactions, or amounts that might affect the fairness of financial statements. Okay, let me explain to you how, when an audit starts, we ask for a trial balance. What kind of a trial balance do we ask for? Okay, here is the chart of accounts. Here is the balance of last year. Okay, I would call this prior year audit. Okay, and then on the cash, accounts receivable. Okay, and then I will call this current year unaudited. Okay, now so here are all the balances of previous year audited. One rule of analytical procedures is that relationships stay consistent unless you know otherwise. What do I mean by that? Here's all the balance for all the accounts for the prior year. Then here is the unaudited. Balance. And then any adjustments during the course, and then current year audited. What do I mean by that? You see that in inventory, the amount has increased by a huge margin. Okay, now either you know for a fact that they are expecting huge amount of sales early part of next year, which is the reason why they are stacking up on inventory, then you know it's normal, so there's a good reason for it. Or on the other hand, what has happened is the purchasing department continues to buy inventory without having a proper process in place. A new purchasing manager has come in, and that person continues. What happens if you just continue to buy and stack up inventory? Doesn't that mean your cash is held up? If your cash is held up, that means you cannot meet other obligations, right? So that is a good example of the areas where you need. So what are you telling yourself? Now, this is one area where I need to start looking as to what can go wrong. So you would immediately highlight inventory because you have found that there is a huge increase in balance. And that may happen in all areas. In some cases, it may be genuine. In other cases, it may not be. But what you have identified is an area where you need to look. So I would say 50 to 60% of the analysis only happens by looking at the trial balance. Okay? And then based on this, if you find mistakes, you make adjustments, and then you have the final balance. So that's how it is basically done. Whenever I have done audits, first thing I ask for is a trial balance. Okay? Unusual events, transactions, or amounts that might affect the fairness. A cost-benefit analysis. When you do analytical procedures, remember, you are providing reasonable assurance, not perfect assurance, or not absolute assurance. So when you do a cost-benefit analysis, you need to keep in mind that the benefits or I should say the cost should not outweigh the benefits. You cannot be spending thousands and thousands of dollars, or I should say hundreds of hours, getting additional help when it may not provide any value, additional value to it. Okay, so you need to keep that in mind. And it must be used as part of overall review stage of the audit. Okay, so how do we do analytical procedures during the beginning of the audit? Continuously while the audit is going on, and at the end you will compare this to last year again to see if numbers fall in place. So analytical procedures are continuously done during the beginning, during the course of the audit, and after the audit is finished. So you got to keep that in mind as well. Okay. Plausible relationship among data may reasonably be expected to exist and continue in the absence of known conditions. During starting of an audit procedure, an organized approach, a standard starting place for becoming familiar with the client's business. Okay, that's what we talked about when I say the first thing you ask for is a trial balance. Develop an expectation. Many times what people do is they have one more area that is called budgeted balance. So that's your expectation. Okay, or last year is your expectation. Look at the difference. If it is a significant difference, investigate. Okay, prior balances, budgeted balances, okay, and non-financial information. For example, this year sales is going to be very low because of the fact that the economy is bad, the tourist industry is not doing well, or it could be many reasons. The tobacco industry. If you're auditing them, sales are going to be low because new standards have come into place which significantly has brought down sales. Some of the products have been outlawed, and all these things, if these are non-financial things that you need to keep in mind. You can get that kind of information from industry ratios or company journals. But what I mean by that is you need to understand the industry that you're auditing. The way it works in public accounting firms is if you start your career with, say, doing food industry, you will end up doing a lot of food industry clients. If you start your career doing aviation industry, you may end up being in aviation, because as you get more and more experience as an auditor, you understand the risks better and better, and you get better and better at it. So you may start as what I call a grunt, just making photocopies, and then eventually as you learn, you move up further and further and further. Okay. The highest risk, as we say, subjective areas. Estimates. Management's estimate. What was the process used? Develop your own estimate, independent. And then look at subsequent. What do you mean by subsequent events? An accrual was made for revenue for $50,000. Look at what actually happened in January and February. Did that actually happen? If not, we have got to reduce that accrual. Okay. Related party transactions. Are they always illegal? No. If a corporation buys a parcel of real estate from one of its executive officers at a very high price, there is a conflict. If you adequately disclose them in the footnotes that there is a related party transactions and the business purpose, then you have done your job. Okay? Now, disclosures of related party transactions does not mean that if they are at arm's length, they should not be disclosed. Anything that is related party has to be disclosed. Okay? And so when you collect evidence is one thing, you need to document your work. Because if you go to the court, if someone drags you to the court that I relied on this auditor's work and I was misled, at that point in time, your working papers is what is going to help you. Okay? And what is that audit documentation? If a new auditor comes in, they should be able to understand what you have done. During peer review, my peer reviewer always tells me, you leave your work, you go outside, I should be able to understand everything that you have done. If I don't, then there is a problem. Clearly should identify who has done and reviewed the work, who is taking the responsibility, which particular auditor. Show that the accounting agrees or reconciles to the financial statements. And that's what your documentation should reveal. Okay. The primary function is it should show that the report that you have issued is based on the documentation that you have gathered and supports the opinion. And then these are your secondary matters. Okay. And your documentation is your working papers. What kind of working papers? Your trial balance that I told you. Okay. Minutes of the meetings of that particular company, your lead schedules, supporting schedules, subsidiary ledgers, your analysis and your reconciliations, your computations, okay, legal letters from the attorney. All these things make up your documentation and has to be assembled in a file. A file of working papers contains data such as copies of articles of incorporation, bylaws, copies of minutes of directors, stockholders and committee meetings, and analysis. And all this documentation should support the ultimate opinion that you have provided. Should be in a permanent file. And then there should be a current file. Now, bylaws and minutes of the meetings and articles of incorporation, all that goes in permanent file. All these things. Okay. Unchanging data. And report for a particular year goes in current file. For example, a working trial balance like this. A lead schedule, and I'll talk about a lead schedule later. Combine certain general accounts and a total of combined accounts. A company like United Airlines has thousands of accounts just for cash because there are thousands of bank accounts. The combined balance of all those accounts rolled up on the balance sheet into one cash balance is called the lead schedule. Okay? And we need to understand the organization of the files. At the top is always the financial statement, followed by the trial balance. This kind of trial balance. Okay? And then you have your lead schedules, cash, index. A is for cash, B could be for accounts receivable, C could be for inventory, D could be for prepaid assets, E could be for property, plant, and equipment, but that's the index. A1 is the supporting documentation to support cash working papers, cross-referenced. So take a look at this. This, from the trial balance, it goes here. Okay, but how does it fall in the trial balance? From the lead schedules. Petty cash, 500. See, all this petty cash, general account, payroll account adds up to 96024 to TB1 right here. Okay, petty cash A1. From A1, 500 went up to here. That's the supporting schedule, the petty cash summary sheet, cash count sheets, confirmations, and reconciliations. And that basically moves up to the financial statements. So that's how you have, and this is a very important schedule that you need to understand. You have cross-referenced this from the working papers. Okay? And this is just for cash. So cash could be A. Now, how could receivables be come into play? Your lead sheet could be your aging schedule, B. And B1 could be the backup of each and every account or the subsidiary ledger, and on and on and on. Okay? And then you have your working papers. So let's take a look. Allowance for C, this is B or C, whatever index you want to call it. Allowance for uncollectible accounts. Now when you look at the bottom over here, here are the entries that you have made. Uncollectible, allowance for uncollectible. How did you come up with those entries? You took the write-offs, you added them up, okay, balance per ledger, you increase the allowance, additional 20,000, and so you wanted this to be 20,000, you need this amount, and you made the entry for that amount. Okay? On March 31st, this was a balance per ledger. Then there was additional write-offs. And then provision for year ended March was this much, balance per ledger is this much. You want the balance to be this much, and so you made an adjusting entry. And here's your conclusion. So what is this? This is nothing more than a working paper of C. C is accounts receivable, so C5 is showing you the transactions, okay? And that's how you have to look at the accounts receivable. Now, this is about what kind of evidence can this be considered. I'll be posting a solution for that. And then AR equals IR times CR times DR, okay? Acceptable audit risk. 6 situations that involve the audit risk. And you need to find out by doing this equation, what is your audit risk? AR equals IR times CR times DR. Okay? Now, as we conclude this chapter, the 2 things we need to remember is analytical procedures, what is involved in there, the risk assessment, and a good understanding of this chart, okay, before we move further. So that in a way is chapter 5. Again, I'll be posting the solutions for this problems. Let's start with the multiple choice, and then let's continue the process that I have highlighted on the syllabus. Thank you, and we will soon get started with chapter 6.